If you're over 60 and you're still putting vacations, furniture, home upgrades, or everyday spending on credit, even telling yourself, I'll pay it off soon, stop for a second. This isn't a small habit. It's one of the quiet things that can unravel an entire retirement. And by the end of this video, you'll understand exactly why it's so much more dangerous now than it was in your 30s, and exactly what to do instead. Let's define what financing your lifestyle really means, because it's bigger than most people think. It's not just an obvious car loan. It's the vacation put on a card because we'll pay it off over a few months. It's the new furniture on a store payment plan because the monthly numbers seemed fine. It's carrying a credit card balance month to month because paying it off in full feels tight. It's the buy now, pay later app split into 4 easy payments for something that honestly wasn't an emergency at all. All of it is the same underlying behavior, spending today's lifestyle with tomorrow's money and trusting future you to sort it out. Here's why this is dramatically riskier after 60. When you were working, debt was uncomfortable, but your paycheck kept arriving. There was room to cut back, room to earn a little extra if things got tight, room to simply wait it out until the next raise or bonus absorbed the damage. In retirement, that flexibility disappears almost entirely. Your income becomes fixed. It doesn't expand just because your balance did. Every dollar of interest you pay comes directly out of an income that isn't growing to compensate for it. It just comes out of what's left for groceries, for healthcare, for the life you actually want to be living. Let's look at the real math because it's harsher than people expect. Say you put a $5,000 vacation on a card charging 20 to 25% interest. Completely typical today. Make only minimum payments and that trip could take years to pay off. By the time it's done, you may have paid several $1,000s in interest on top of the original $5,000. That vacation didn't cost $5,000. It cost $7,000, $8,000, maybe $9,000 for something that lasted a week and is now mostly a memory, while the bill is still very much alive. Now multiply that pattern across an entire retirement. A financed vacation here, financed furniture there, a card balance that never quite hit zero, a pay-in-4 purchase every couple of months because each one feels small on its own. Each one feels manageable in isolation. Together, they quietly become one of the biggest leaks in a retiree's budget, funneling money straight into interest payments that buy you nothing instead of into savings that could be growing for you, compounding in your favor instead of against it. Here's the part that should really concern you. This kind of debt in retirement isn't just expensive, it's structurally dangerous. You're betting that a fixed income will always stretch far enough to cover both your actual life and the interest on your past spending. That's a bet that gets harder to win every year, especially as healthcare costs and everyday prices keep climbing, while your income stays essentially flat, adjusted only slightly, if at all. So why does this trap catch people specifically after 60? It's not a willpower problem, it's a mindset carried over from working years. For decades, can I afford the monthly payment was a reasonable enough question because your paycheck usually kept growing to match it. A raise here, overtime there, a bonus that quietly absorbed whatever new payment you'd taken on. In retirement, that same question turns dangerous because a fixed income has no built-in room to absorb new monthly obligations. There's no raise coming next year to make the payment feel smaller. If anything, rising costs elsewhere make it feel bigger over time, not smaller. There's an emotional piece too, and it's completely valid, so let's not skip past it. After decades of hard work, there's a real pull to finally enjoy life. Trips you postponed, upgrades you delayed, things you told yourself you'd get to someday. That instinct isn't wrong. You've earned it. The problem was never wanting to enjoy retirement. The problem is financing that enjoyment with debt instead of funding it with savings. Because debt in retirement doesn't just cost money, it costs your security. And security is the entire point of retirement. It's the thing all those years of saving were actually building toward. And finance spending quietly chips away at exactly that. Let's talk about a pattern that catches a lot of people off guard. The small payment illusion. A furniture store offers 18 months, no interest on a new living room set. It sounds harmless. No interest. What's the risk? The risk is that no interest almost always comes with a deferred interest clause. If the balance isn't paid in full by the exact end date, interest gets applied retroactively to the entire original amount, not just what's left. Miss that deadline by even one payment, and you can suddenly owe months of accumulated interest all at once. These offers are designed to feel completely safe while quietly building in a trap for anyone whose payment schedule slips even slightly, which, on a fixed income with unpredictable expenses like medical bills or home repairs, happens more often than people expect. Let's also talk about buy now, pay later apps specifically, because they've become so normalized that many people don't even think of them as debt. Splitting a purchase into 4 payments feels like nothing. It's marketed as basically the same as paying in full, just spread out a little. But stack 5 or 6 of these across different purchases in the same month, and suddenly you have multiple automatic withdrawals hitting your account on different dates for things you've often already forgotten you bought. This is one of the newest, most invisible versions of lifestyle financing, and it's specifically designed to not feel like debt at all, which makes it more dangerous, not less. So why does any of this matter more now than it would have at 30 or 40? Because at 30, a debt mistake is a setback. At 65 or 70 on a fixed income, a debt mistake can become a permanent structural drain that never fully resolves. Because there's no future raise, no next promotion, no extra decade of earning years left to quietly absorb and correct it. Time, which used to be your biggest ally for fixing financial mistakes, is now working differently. That changes the entire risk calculation around every small finance purchase. So here's the mindset shift that changes everything. Separate "I want this" from "I can pay for this in full right now," without borrowing a cent. This doesn't mean giving up things that bring you joy, it means changing how you get there. Instead of financing next month's trip, build a dedicated travel fund and go once it's actually paid for. Instead of store financing on furniture, save for a few months and pay cash when you're ready. Instead of splitting a purchase into 4 payments because it feels painless, ask whether you'd still want it enough to pay the whole thing today. That one shift, spending money you already have instead of money you're borrowing against your future, changes whether your lifestyle is actually sustainable, not just this year, but for the next 20 or 30. Here's how to build that habit in practice, step by step. First, create sinking funds for the things you genuinely want: travel, home projects, gifts for grandchildren, a special occasion. Estimate the cost, divide it by the number of months until you want it, and set that amount aside automatically, the same way you'd set up any other recurring bill, except this one pays your future self instead of a lender. When the time comes, the money is already there. No financing, no interest, no debt hanging over the memory afterward. Second, if you're currently carrying a revolving credit card balance, killing it becomes your top financial priority, even above other savings goals temporarily. Paying off debt charging 20% interest is essentially a guaranteed 20% return. Almost nothing else in personal finance offers that kind of certainty. And every dollar you put toward that balance instead of a new purchase is doing more for your financial health than almost any other move available to you right now. Third, before any larger non-essential purchase, apply one rule. If you can't pay for it in full without touching your emergency fund, you're not ready yet. Not never, just not yet. The purchase itself might be completely reasonable. The only question is whether you've actually saved for it, or whether you're quietly borrowing against a future that can't absorb it the way it used to. Fourth, if buy now, pay later offers keep tempting you, ask one honest question before every purchase. If I had to pay this in cash today, right now, would I still buy it? These programs are specifically designed to make spending painless in the moment and push the discomfort down the road, where it shows up later as a half-forgotten bill. That one question breaks the spell almost every time. Fifth, audit everything you're currently financing all at once in one sitting. Every card, every store payment plan, every buy now, pay later split. Write down the balance, the interest rate, and the payoff date for each one. Most people have never actually seen this list assembled in one place, and seeing it together, rather than as scattered, seemingly small monthly payments, is often what finally makes the real scale of it click. Sixth, once you've paid something off, resist the urge to immediately replace it with something new financed the same way. This is where a lot of progress quietly gets undone. A card gets paid off, and within a month or two, a new purchase creeps back onto it because the room feels available again. Treat a paid-off balance as a finish line, not a reset button. And here's the deeper truth underneath all of this. Retirement security isn't only about how much you saved. It's about how disciplined your relationship with debt becomes once your income stops growing. Someone with a smaller nest egg and zero finance lifestyle spending can genuinely feel more secure than someone with a bigger nest egg quietly being drained every month by interest on vacations, furniture, and old balances. It's not just the size of your savings, it's how much of your fixed income is being redirected to a lender instead of your actual life. Think about what that redirected money could actually become instead. The same few $100s a month currently going toward interest payments, if redirected into a simple savings fund instead, could become next year's vacation, fully paid for, with nothing owed afterward. It could become the cushion that covers an unexpected car repair without a second thought. It could become the peace of mind of knowing that every dollar coming in each month is actually going toward your life, not toward interest on your past. If you're already carrying this kind of debt right now, this isn't about guilt. It's about making a clear decision to change direction today. Look honestly at every card, every payment plan, every balance you're carrying. Know the real interest rate on each one. Attack the highest interest debt first, even if it means slowing down other spending temporarily. And going forward, save first, spend second, for anything that isn't a true emergency. Here's the truth I want to leave you with. A comfortable retirement isn't built by avoiding enjoyment. It's built by paying for that enjoyment honestly, with money you've already saved, not money borrowed against a fixed income that has nowhere to absorb it. Stop financing your lifestyle. Start funding it instead. The trip might look the same. The furniture might look the same. But what's happening underneath is completely different. And that difference is exactly what decides whether your retirement feels secure or feels like it's slowly slipping out of your control. If this hit home, follow along. I share practical, real-life financial strategies made specifically for people building a secure, confident retirement. And tell me honestly in the comments, is there something you're currently financing that, after hearing this, you'd rather save up for instead? Let's talk about it.